Good afternoon, everybody. This is Arnold Vandenberg recording this Tuesday, March 10th in the afternoon after the market was closed. We hope to cover the things that you're most concerned about, that is the oil market, how the coronavirus is affecting the economy and the stock market, and finally the stock market itself. Jim is going to be covering the coronavirus and the economy. I will be covering the oil market and the stock market. So let's start off with the slide of oil, West Texas Intermediate Crude, WTI. And we're showing you a history of the oil market for 15 years. Now, during this chart, in the 15 years, as you can see on the graph, we've drawn a line at the bottom, and that is a very important line, because on this chart, it'll show you that in the last 15 years, it has only hit below 40 3 times. The first is in 2008. It was below 40 for 24 days, and it hit $34. The next time was in 2016, which was the lowest in the last 15 years at $26. And just recently, in the intraday correction yesterday, it hit $27 and closed up at about $30, and it's about $34 today. So the thing that I want to point out is how little time it has spent below $40. In the last 15 years, it has only stayed under $40 for 103 days out of 3,800 days. That's 15 years. In other words, the time it spends under $40 is less than 1% of the time. And the reason that's significant is because we really believe that's the ultimate bottom. We believe that the oil market made a bottom, a very climactic bottom, yesterday. We believe that this is the beginning. From here on in, we believe that oil will go into a bull market that will last many years. Now, there is a possibility, because there's negotiation between Russia and Saudi Arabia, that there's a possibility that things break down and it could possibly test that bottom, but that would be about as low as it'll go. The reason that oil doesn't stay under $40 because very few people can stay in business and produce oil and shale at that price. Matter of fact, the price probably has to be $50 to $55 to be sustainable. Now, in the chart, I show that at $60 to $70, and that is the green part on the line there, as you see in the middle, it spends more time in that time than any other time, and that's where we believe the price of oil should be right today, based on all the fundamentals, and that's where it spends the majority of time. Now, as you move up over 80, 90, and 100, it spends time there too, but not as frequently. So we believe this $34 price where it is today is just completely out of line with history, and we believe that it will go up very dramatically over the next few years, and the investments that we have in oil will prove to be very good investments, even though they have not performed anywhere near what we expected, especially over the time frame that we've held it. We also have the opportunity, a rare opportunity, to buy the very best oil companies because they all fell out together. And we are going to be switching. We've already made some switches, and we're going to be making some switches from companies that are very good, but we can have the very best now because the Cadillacs are trading at the same price as the Chevy, so why not switch the Chevy into the Cadillac? And we're doing that in the rest of the market as well. But that is our particular opinion at this particular point. And now we're going to move on to Jim. And Jim is going to tell us about the coronavirus, and he's also going to tell us the effect that it's having on the economy, and especially what's happening in China.
Good afternoon. First, if we look at the economy through February, the economy's actually been on a strong footing. Looking at the jobs number, non-farm payrolls added 273,000 jobs. in February versus an estimate of 175,000 jobs. So the jobs market remains strong. Financial conditions for the consumer is the strongest it's been in 30 years. Banks are well capitalized. And yesterday, the small business report for February was the highest in 3 months at 104.5, beating the expectations of 102.9. So through February, the economy has been strengthening from the soft patch that we experienced during the fall, which that was largely due, of course, to the trade tensions that were occurring then. So on its own, the economy is in very good shape. The major concern, of course, is the impact that the coronavirus is going to have not only on the health and well-being of Americans and people around the world, but the significant impact that it could have on the economy. The biggest issue from an economic standpoint is that it adds fear and significant uncertainty, which causes people to delay business activity and investment. It's impacting travel. Large conventions are being canceled. Events are being canceled. So this is obviously having an economic impact. And it will certainly show up in a slowing economy as the coronavirus develops throughout the United States. The major question, of course, is will it slow the economy enough to cause a recession? Well, in our view, whether we have a recession or not depends largely on the speed, the level, and the targets of both fiscal and monetary response. So far, the Fed has lowered rates and has pledged to use all monetary tools available. But lowering interest rates will only provide a limited amount of benefit, primarily by maintaining the liquidity in the system and making sure we've got enough liquidity. Fiscal support is really what's necessary. And here the President and the Congress have been working on various fiscal packages to provide support for those that may be affected. Potential support packages being considered include insurance companies waiving co-pays, uninsured patients being covered, hourly workers getting paid sick days, financial support for the airlines and hospitality industries and small business if they need it. There's payroll tax relief proposals. It's not a complete list, but the point is that both the Fed and the government have committed to provide the necessary fiscal and monetary firepower to help avoid a recession. Additionally, we've been watching the impact that the coronavirus has had on China and its economy and looking for signs of recovery, because that'll give us somewhat of a benchmark on how this will play out around the rest of the world economically. So far in China, we're starting to see some encouraging signs of a recovery. First, the new cases of coronavirus and deaths are declining in China. In fact, they're shutting down some of the temporary hospitals in Wuhan and sending patients home. Nearly all Apple stores have been reopened. Starbucks are opened. China has seen a sharp increase in bulk carriers that are entering China, a sharp increase in container ships, and an increase in crude tankers. But perhaps the most telling sign is that President Xi had traveled to Wuhan claiming victory that they have conquered the issues around the coronavirus. These are all indications in our view that China is now getting back to work. We're seeing that in some of the early signs of the economic data and company reports, which we think will show up in an improved Q2 economically in China, and that'll also have some feed through to the rest of the world. So as long as the support is targeted and timely, the U.S. certainly has the firepower to weather through the corona shock without it necessarily resulting in a recession. Arnold?
Thank you, Jim, for that update. Now let's talk about the next chart we're going to talk about. That is my favorite chart, and I've been keeping this up to date on a weekly basis since we started the business 45 years ago. And the reason I like this chart so much is because most people who follow the market follow either the Dow or the S&P. But I follow the value line because it is more representative of the average stock. In the value line, you have 1,700 companies instead of 500 in the S&P. So it's a much broader list. It's a better idea of the averages. And it never gets so far out of line that any one big company can influence the index. And that's what I like about it, because many times the S&P 20, 30 stocks carry the ball and the rest of the stocks aren't doing that well, or it gets extended like it did in the tech bubble, where the tech bubble carried the S&P to a 35 PE while the value line was at a 10 or 11. That told us that market was very cheap, even though the S&P was very overvalued. So let's get back to the value line here. And I'm showing you the bottom here on my right-hand side, the value line PE. This is in an environment where the BAA corporate bond yield is 5% or less. Now that's important, because valuations are not only important as to what the company's earning, but what is the interest rates. And we are operating in an interest rate environment that is the cheapest in probably 40 years, 30, 40 years. So we try to put the valuation based on the environment, and 5% or less is a good indication. Now, what is interesting, well, in a normal environment, the PE is the bottom is 10. In this kind of an environment, even if the interest rates went up a couple of percent, we would still be in this environment. So what happened is that when you have interest rates at 5% or less on the BAA, and I've searched our database for over 45 years, and I gather what is the lowest PE. The lowest PE in this environment is 14 times earnings. Now, what is interesting, the other day, the value line PE, it's the yellow line on the bottom, got to the 14.5 to 15 level, which means that out of 45 years, this index at these levels, at this interest rates, has traded higher 95% of the time. Now, if it dropped to 14, which is the 14 to 14.5 area, that's the blue area, that means that in this environment, the stocks would have traded up over this level 99%. Doesn't tell you how much it would trade over, but it tells you that most of the time it'll trade higher. Now, what's interesting is if you look at the 13.5, 14, there's never been an indication that it's gotten this cheap. So we got to the 14.5 to 14.9 level, which is the yellow line, which would indicate from this level, in a normal correction, you would only have a 5% risk from the level that we had yesterday. Now, we haven't covered the idea of a recession, and that is the thing that we're the most concerned about, because there are many indications that there are possibility, or certainly the risk has increased, especially because of the coronavirus. That's why we're monitoring China so closely, because that's our first indication. We already have changed our portfolios, and as you've noticed the trading in the last few days, we're upgrading the portfolio because in the sell-off, we were able to buy high-quality stocks, kind of like what happened in the oil market, where we can buy the Cadillacs instead of the Chevrolets. So we are making changes for that because we have the opportunity to do that. Also, we have cash built up, which we'll be using when opportunities come. If we go into a recession, I would say, based on past statistics, we would have another 10 to 15% risk in the market from the level it was the other day. So this is what we're monitoring, and that's what we're going to be doing. And if we see any concern that that's going to happen, we will move very aggressively to protect the portfolios. But at this particular point, we feel that everything looks very good at this point. Valuations are back in line, and we have been able to upgrade the portfolio by finding some stocks that fit the bill. So that's all the information we have today. Thank you for listening. And if you have any questions at all, please do not hesitate to call your representative. Thank you very much.